Next up, and you would think it would be a short little section, but no, this section is pretty long. It will probably be at least 2 videos. Earnings per share. All right, EPS, which is earnings per share, must be reported on the face of the income statement. All right, the income statement is not complete without it. Basically, okay, at its simplest, which you know we're not going to stop with, simplest, is that how you spell that? It equals net income divided by number of shares of common stock outstanding. All right, that's at its very simplest. And of course, we're going to make it more than just that. All right, a lot of people use earnings per share to evaluate corporations and try to decide if they want to invest in them. It's a super important number to corporations. They forecast it a lot, and if they don't meet their forecast, then, you know, things are horrible and all that kind of stuff. Okay, so let's see what we talk about. All right, price earnings ratio is also used for comparison purposes. So price earnings ratio is basically what it says. It's the market price per share divided by earnings per share. Right, and once again, that's just another number that investors calculate and compare to past years and to other corporations and things of that nature. Okay, so there are 2 types of earnings per share that have to be calculated, that I'm going to say may have to be calculated. There's basic earnings per share and diluted earnings per share. All right, basic earnings per share is always required. Okay, everybody has to have basic earnings per share. Diluted earnings per share is required for complex capital structures. And it's a hypothetical number. All right, it's not going to actually be a real number. Now, when you talk about capital structure, all right, simple capital structure means that there are no convertible claims on common stock. Okay, which means nothing exists that can be converted to common stock. So no bonds payable that can be converted to common stock, no convertible preferred stock, there's no stock warrants or stock options, you know, none of that stuff exists. There's literally just common stock outstanding and that's it. There's only common stock. There could be preferred stock too, but there's only common stock outstanding, and that's it for common stock. All right, earnings per share only applies to common stock. All right, a complex capital structure means there are convertible securities that could impact the number of shares of common stock outstanding. All right, so there are convertible bonds, convertible preferred stock, stock options, etc. outstanding. And we're going to calculate both of these. All right, we're going to calculate basic earnings per share and diluted earnings per share. All right, so basic earnings per share is net income minus any preferred stock dividends, if there is preferred stock. So if there's no preferred stock, then you don't have to worry about that. But if there is, then you have to subtract it out. And it's divided by the weighted average number of shares of common stock outstanding. Okay. All right, so let's see what this example is. All right. During 2019, Branson Company reported net income of $48,000 and declared and paid dividends of $8,000 on its non-convertible preferred stock. It also pays dividends of $12,000 on its 16,000 shares of common stock that had been outstanding for the entire year. So basic earnings per share in this case is super simple. Spelling is the hardest part. It's going to be the net income of $48,000 minus the $8,000 in dividends on preferred divided by the 16,000 shares of common outstanding. All right, and that is a $1 per share figure. Not per hair, per share. All right, and this would go right below net income on the income statement. Okay, so a couple of things here to pay attention to. If it's, all right, so for preferred stock, if it is non-cumulative, which means they don't build up if missed, you subtract the dividend only if declared. All right, if cumulative, subtract the dividend whether declared or not. Because they're going to have to go back and pay it if they miss it. All right, denominator calculations are the shares outstanding. All right, so if you remember the denominator, my Lanta, I'll fix that later. It's the weighted average number of shares of common stock outstanding. Okay, so basically what that means, like let's say for instance, I start off January 1st. I'm going to use my example first, then I'll go to theirs. I start off January 1st with 10,000 shares. Okay. And then October the 1st, I issue another 5,000 shares. All right. So at December 31st, I now have 15,000 shares outstanding. All right, if I just divide by the 15,000, then that implies that I had the money from those 15,000 shares all year long to invest and earn a profit for me. But I did not, okay? I only had the money for 10,000 all year. So to do my weighted average, I'm going to multiply this by 12 over 12 because it was outstanding all year. All right. So this is going to equal 10,000 times 1, basically. Okay. And then this one, I'm going to multiply by October, November, December by 3 over 12. All right. So weighted average only had 1,250 shares there. So the weighted average is going to be this 11,250. All right, if you divide by the full 15,000, then you're going to understate your earnings per share. And trust me, corporations do not want to understate their earnings per share. Okay, so let's see the example here that they did. All right. At the beginning of the year, they had, so at 1/1, they had 15,000 shares. On March 1st, they issued 2,700. On July 1st, they issued another 3,300. And then on December 1st, they bought back 600 as treasury stock. All right, so they currently have 20,400 shares outstanding. I need to prorate it. So the one for January 1st was out all year. March 1st would be March, April, May, June, July, August, September, October, November, December, 10 out of 12 months. July 1st would be 6 out of 12. And then December 1st would be 1 out of 12. And then add those up. And the weighted average is 18,850. Well, they do theirs a little different. I prefer my way. I did each individual one by the whole time it was outstanding. They did a cumulative. So for 2 months, they had 15,000 shares. For 4 months, they had 17,700. For 5 months out of the year, they had 21,000, and then they had 20,400. I like my way better, and you get the same answer. You can pick either way you want to do it. Okay, if you have a stock dividend or stock split during the year, remember that's when they do like a 2-for-1 stock split. Stock dividends and stock splits are accounted for retroactively. All right, which means you assume it happened at the beginning of the year. All right, so basically it was out all year. Okay, so an example for that. All right, they start for 2019. So in 2019, I think, did we already talk about it? I don't remember. All right, so we had 5,000 shares. Dude. All right, and then they had a 2-for-1 stock split. So 10,000 is the weighted average. I'm gonna put that over here. Okay, then in 2019 or 2020, all right, at January 1st, we're going to start off with the 10,000, all right, that we had from here. Okay, we're starting off with 10,000 that we had from here. All right, then on June 1st, and we had that all year. So it's going to be times 12 over 12. All right, then on June 1st, right, we issued another 5,000 shares. So that's times 7 over 12. Then in August, we did a 20% dividend. Doesn't really matter the date. We did 20% dividend. Okay, now what that means is I have to go back up to here, and these are both going to increase by 20%. So I'm not going to multiply by just the months. I'm also going to multiply by 120% or 1.2. Okay, because I now have 20% more than I had, so it would be 120%. I'm going to do the same thing for this one. Okay. Then October the 1st, I issued another 2,000 shares. October, November, December, so that's times 3 over 12. It did not participate in the dividend because it was not outstanding yet at that time. All right, so now I multiply all these out. 10,000 times 12 over 12 times 1.2. 5,000 times 7 over 12 times 1.2. And 2,000 times 3 divided by 12. And then add them up. And this is my weighted average. Stop. Ugh. Dude. A little mouse pad thing is bothering me. Okay. Okay, so this is an example. I was like, what is this? This is an example of the actual basic earnings per share. All right, so income statement information for Caswell. Net income was $14,000. They also had an extraordinary gain, net of income tax, of $3,600, which is included in net income. Shareholders' equity, they have preferred stock, 8%, $100 par, $30,000 total par value. Common stock, $10 par, $60,000 total par value. Okay, so one thing that we need to know is what's the preferred stock dividend and how many shares of common stock are outstanding at the moment. So, Caswell example. All right, our preferred stock dividend is going to be 8% times the total par value of $30,000 We'll look to see in a minute if it's cumulative or non-cumulative or whatever. Okay, so that's how much their dividend would be. Common stock outstanding at end of 2019. All right, it's going to be the 60,000 total par divided by the par value per share of 10. So there are currently 6,000 shares. And this was a dividend, so this was dollars. All right, additional information. This is the end of 2019. Okay, so no preferred stock was issued or required during 2019. Preferred dividends were declared during 2019. A review of the common stock account shows that on January 1st of 2019, 2,000 shares of common stock were outstanding. And now we have 6,000 shares. Okay, so something happened. So we've got to figure out our weighted average. So at January 1st, we had 2,000 shares. On April 1st, 500 shares of common stock were issued for cash. On June 1st, we had a 2-for-1. Resulting in 5,000 total because we had 2,500. So that's going to double to 5. And then on November 1st, another 1,000 shares were issued. All right, so my total here is actually going to be 2,000 times 2 because I split. Oh, shoot. 2,000 times 2 plus the 500 times 2 and then plus the 1,000. Okay, so that's the 6,000 I have outstanding right now. All right, for my weighted average, my 2,000 at the beginning is going to be times 12 over 12 and then times 2 because it doubled. Okay, my 500 is going to be April, May, June, July, August, September, October, November, December. 9 over 12 and then times 2 because it was outstanding before the stock split. And then my 1,000 is just going to be times 2 over 12. So add those up. How did they round? Let's see. Rounded up to 49.17. And that is my weighted average. All right, so now to do my earnings per share. I'm going to have my $14,000. I don't know what they're doing there. I'm going to have my $14,000 net income. Minus the $2,400 in preferred stock dividends. Divided by the 4,917 shares. And that's a per share number. Dollar per share number. Okay, notice on the income statement what they're actually going to do. All right, this is just for bottom line net income. So on the actual income statement, they're going to have income before discontinued operations. I thought it was an extraordinary item, but anyway. Was 10.4. Then they had 3,600 on discontinued operations. So net income was the 14,000. Okay, so this is the bottom of the income statement. And then for earnings per share, you would have, well, actually what you might have is, a lot of times they put it over here on the side. This one they did down below, but sometimes they do out to the side. All right, so this is actually going to be your 236. Oh. And then they're going to show these separately. So for the first one, you would actually, you would do the income before discontinued operations. You would subtract out the dividend and then divide by the number of shares. All right. When you do the little insight number, though, for the discontinued operations, you do not subtract out the dividend. And then they should add up. In this case, you would add them up, and they should add up to the 236. And they do. All right, so sometimes it might be off to the side, sometimes it might be down below, but it has to be somewhere. And here they tell you how to calculate the numbers. Okay, so I'm going to post this and then do another one for diluted earnings per share because this video is already very long.